At 10 for the market open, and while yesterday we fell about almost 0.5% or so, volatility continues to be really the name of the game. This morning, the pre-open rates are settling in at a bit of a quiet start, though sub that 17K mark. Who knows from here where we actually head? Because looking at the Asian screen, we're still down and out. Australia's down 1.5%, 1% down for Japan. Hong Kong is well lower by about 1.5%, and China too is down about almost 0.5% or so. Although right now, still early days, but the US futures are indicating a mildly positive start. So let's see which way we actually head from here. But these are tricky markets to call.
Aisha, look, there is a fear of an unknown risk, and the fear of unknown risk cannot be measured. Markets are nervous. That's as simple as that. And when markets are nervous, there is a compulsion, there are technical factors, there are redemption factors, there are a lot of factors which are at play. For markets to bottom out, either the news has to change or prices have to become meaningfully attractive. I don't think we are there yet. Prices are not meaningfully attractive if you look at the next 2 quarters of earnings, and the fear of contagion that, from US to America, from America to Europe, and from Europe to maybe, some other geography, this entire banking crisis would spiral through, I think is a real fear. Whether this real fear will translate into reality or not, that nobody knows. But this is something which will keep on hammering the market sentiment down. So the market sentiment was fragile and has really become further nervous. So I'm not saying the news has become from bad to worse. In fact, one thing is evident, that decline in commodity prices, the fact that central bankers have stepped in to bail out Credit Suisse or SVP just tells you that no central banker wants any kind of a structural collapse, is good news. But when you see a event like this, it just pushes everybody on the edge. So the desire to trade long clearly is not there. And prices are not that attractive that the contra buyers, the deep value buyers are going to be coming out. First rates any seconds now, and we will start with it's not a great start, guys. Credit Suisse problem looks like they've been bailed out, but look at the market. First rates down, breadth negative, with the exception of maybe a little bit of crude derivative beneficiaries, oil companies, paint companies, few FMCG companies which are in the import. That's about it. The market is not showing any signs of excitement, or it is not picking up any weight. Let's look at the bank Nifty, especially the private banks. They are the FI dominated banks, and are they now having an effect of real global FI selling? And HDFC Bank is down, ICICI Bank is down. For the moment, SBI is not going anywhere. Kotak Bank is just about flat. Adani group of companies, the real harbinger of the market mood. That's where the risk quotient and the volatility quotient has been high. 23 rupees down for Adani Enterprises, 4 rupees up for Adani Ports, flat start for Adani Power, and for Adani Transmission also it's a decent start. So Adani group of stocks were off to a decent start. But what do we have? The market which has immediately slipped in red, no follow-up buying. SGX was telling us a different picture, and the bank Nifty has lost another 0.5%.
Yeah, absolutely. Let's see what the oil sensitives are up to. The fact that, Brent has seen a significant cool off now and it's standing at 2021 lows. Interglobe Aviation, Brent now below $74 to a barrel, and of course Asian Paints are the two cases in point which are going to be in focus. Maybe not so good news for ONGC and Oil India. They may not be holding out well at all. Hero MotoCorp as well, they've launched this 100cc variant of Shine at 64,900 rupees per piece, which is the ex-showroom Mumbai prices. Samvardhana Motherson as well, wherein the promoter Sumitomo Wiring is looking to sell about 3.5% stake. I think that block deal has happened. The stock is sharply lower, 9% down as we speak. And then what is Patanjali up to? The exchanges have frozen the promoter shares on MPS non-compliance. The management just spoke with us. This, sentiment obviously sour in Patanjali Foods. It's down about almost 3% as we speak right now. Besides that, there's really not a whole lot to really discuss in terms of a news flow. That's pretty much it when it comes to stocks which are going to be sensitive in today's trading session. HPBP both are holding out, as is IOC. Torrent Pharma, Oro Pharma are seeing some smidge of green. Metals are the ones which are cracking and dragging the markets lower on the other end. So Hindustan Copper, Hindalco, Nalco, Vedanta, they're all a sea of red as we speak right now. Early days yet, I think, Kunal. It's very difficult to call what trend the market is going to see eventually up until close. Besides that, metals are falling hard.
Well, yes, Aisha, because I think there's going to be a lot of different strategies which could play out. Traders booking out their short positions, portfolios being squared off to try and pare down the risks, etc., etc. So there would be many strategies which would play out in the first half an hour, first 1 hour. So I think we have to look out for a broad trading range now, where the market settles into and whether the bulls make a strong intraday comeback. So I think that's the pattern which we should be watching out for. And of course, if there is any significant drop in India VIX. The trade which I would look out for in terms of the opening trade would be India IEX. I think that's a stock which I think looks attractive, closed above the 200-day moving average yesterday. So that's a stock which I would suggest to buy.
All right, Nooresh, let's get in your first trades.
So that's a buy on power trade. The stock has given a breakout above the 230 mark, a fresh flag breakout, not far away from an all-time high on a dividend adjusted basis. Expecting this to continue towards 250.
Rahul Basin joins us now. Let's connect with him to understand that what he makes up of the news first and the impact it will have on Indian IT and in the Indian financial sector. Rahul, good morning. Thank you for joining us. Rahul, first, for our viewers, in very simple terms, if you have to really decode the news for us, what it means for financial markets, is this tip of the iceberg or the storm has come and gone and central banks have managed to contain the crisis?
Well, I think this was a crisis which was waiting to happen at one level. The world kind of got used to zero cost of money, and that can be quite an opium. Now, if you think about it, the world as a whole has, on a $90 trillion GDP, has $300 trillion of debt. This $300 trillion of debt was being funded. I mean, if you just say about a year ago, on the average cost of funding that debt was about 1% a year, which is $3 trillion. That number of funding that debt has changed to 5%, that means from 3 trillion it's gone to 15 trillion just to fund that outstanding debt, which means an increase of 12 trillion a year. Now, if you imagine that the average duration of that debt is 5 years, that means that for 5 years you would lose another additional 12 trillion. So therefore, the present value of that debt outstanding globally has to be less at least by $60 trillion. Now, I've of course ignored the present value implications, but that would be just a rounding off error. Now, a very significant part of this debt and this bond portfolio and government debt, etc., is sitting on banks' balance sheets. Now, a lot of them are not being reflected because of the accounting policy of held to maturity. But even if you don't account for something, the economic cost is very much there, and which is what is leading to this kind of precariousness. And we saw this happen in SVB. SVB, to my mind, had much more specific challenges. Number one, I feel that as a bank, they did not manage rate risk. If you're holding a bond portfolio as a bank, and you think that interest rates are likely to go up, and it was very clear to the whole world that we hit the bottom, you can do interest rate swaps and hedge yourself against that risk. You can also keep, a bond portfolio with lower duration. You can also buy swaptions and different kinds of protections. And you can also increase your liability mix so that it matches the asset mix. SVB didn't do any of these things. So if you ask me, very sloppy treasury management at the very basic level. Two, you cannot buy, 10-year assets with overnight money. You can do it to a small extent of your book, but you can't have $80 billion of such assets on a $200 billion balance sheet. I think it was just, the MCO risk was not managed, the rate risk was not managed. So it was just, to my mind, very, very poor management. On the credit side, SVB also had, exposure to the venture debt market. The venture debt market basically lends to startup companies, etc. I'm not sure what the exact size of their book was, but it was in excess of $20 billion. I think it was almost 24, 25 billion.
$30 billion,
Venture debt book. Now, venture debt works brilliantly when, follow-on funding rounds are happening. But when you're lending to a loss-making business on the premise that the next round investors will come in and take you out, that's a fantastic strategy in a bull market. It's a fantastic strategy when interest rates are going down. But on the flip side, you tend to get hurt. Now, if you look at the risk-return profile of that business, you have all of the downside risk of the early stage ecosystem, but your upside is capped. So therefore, through the life cycle, you tend to get hurt. And you're just at that point in the life cycle now where you are going to get hurt. So
right, Rahul. So just to, thank you for that brilliant way in which you've just broken it down for our viewers. Now I'm going to come to something specific. At Bearing Private Equity, you have investments in IT companies. Now, IT companies have a direct implication of what will happen to the BFSI space, whether it is Credit Suisse or what's happening to American regional banks. In your understanding, what will be the impact of this for the Indian IT stroke BFSI space?
Okay. Let me address the BFSI bit first because it links to what I was commenting earlier. I think the Indian banking system is actually in a much better place than the rest of the world. And I think that's because we've been through a crisis. We've been through, the bad loan exposure, the balance sheets, and the equity base of a lot of the public sector banks being wiped out, therefore constraining credit growth, therefore constraining GDP growth. We've been through this cycle. We've come out of it. We're at that point in the cycle where a lot of the bad loans have been washed out, and we are actually sort of on a good runway going ahead. Now, the one thing that I'd like to point out from a global ecosystem is that when banks' balance sheets get impaired in this fashion, their lending comes down, and therefore that would also impact global growth. Now that global growth being impacted now I have to link that to the IT industry. That would definitely hurt the IT industry too. One, if you look at the large tech companies globally, the real challenge is that a lot of their revenue models or their models to capture value actually come from the advertising industry. And advertising is one of the highest beta industries in the world, which means that when you have a slowdown, the slowdown of that revenue tends to be much sharper. So that, you will see that short-term impact. Another impact you will see, which is not related to this, but just fundamental to the nature of technology, is that it tends to eat itself. There is a degree of cannibalization. So if you see things like Chat GPT or OpenAI and different kinds of AI platforms and machine learning interventions in the world, you will see that it will actually eat into a lot of basic repetitive work which was done manually. So
Right.
I think there is going to be a transition phase on both those counts for the tech industry too.
Sure. But, I just want to pick up on the recent most example, that of Credit Suisse, Rahul. I mean, 10 years back, yes, it may have been significant. I don't think anymore. But, more than anything else, it really seems that sentiment is really fragile, which is why, this sell-off synchronized almost across the globe. What do you think can really change the sentiment? And I'm not talking India specific, pretty much across the globe.
Yeah, I think first let's look at Credit Suisse. Credit Suisse has always operated on the marginal credits. They were never as a bank and as a franchise, they never operated on the AAA credits. They always took much more credit risk. And when you have economic volatility of the nature that you're seeing and the kind of down cycles, these kind of organizations will get hurt. So to my mind, that was only to be expected. But as far as the fragility is concerned, you have a, like I said, the very large wipeout of the present value of the outstanding debt. A lot of that is on banks' balance sheets. I think people may not be able to understand it, in any form of detail, but intuitively they know that values got destroyed. So there is a, and to my mind, caution which is there, correctly there, but also, the slowdown in the ability to lend and therefore the broad money contracting from that perspective, and slowdown in economic growth. I think it has to make people cautious, and I think that's only appropriate. And I think that it's going to be a challenging times for central banks around the world to not destroy confidence. They will have to intervene much more. I think that the big risk the world runs today is that we have some degree of stagflationary risk, and I think that one has to sort of orient one's portfolios in that perspective. I mentioned earlier, India, I think, is in a different sort of part of that cycle. We do not have the debt to GDP issues that the rest of the world has at this moment. Our tax collections have been much more robust. We've seen a lot of cumulative economic reform the last 30 years, and I think you're seeing the impact of that. We have jump-started on the technology front with digital stacks in governance models, etc. So I think you will see a lot of benefit and you will see a much higher structural growth in India. I think the challenge with Indian markets is a little different. It's that a lot of this upside is actually built into the pricing. And when the rest of the world is looking that much shakier, then that difference in valuations of pricing tends to look a little bit more stark. So my own sense is it's not that I expect any kind of major sell-off in India, but I do think that one will see pretty serious time correction. But if one has a 5-year view or longer in India, I would still be a buyer of equities.
So what would you buy, Rahul? That's the next question from that 5-year long-term view.
Yeah, and look, there are so many changes taking place, right? So, there are sectors, the China plus one, the manufacturing ecosystem. It's got to be a great opportunity in India. And if you look at the availability of workforce in the next decade, we are the only country in the world which has that kind of labor force available. If you take out countries like, Nigeria, Pakistan, etc., which are very tough to actually for any global manufacturer or company to base their supply chains out of, just because of the uncertainty and the volatility associated with those countries, right? The transition from the IC engine to the EV engine, you're on a structural growth path. AI is another area which is, you can see around the world that's going to significantly change things. Cybersecurity is another area where you get tremendous amount of growth, right? Engineering services, the world is moving to more and more defense expenditure. So I think you'll see a lot of these kinds of changes taking place.
So let's talk about the stagflation scenario. If there is stagflation, that's bad news for everybody, and especially for equity markets. That's like the most scary scenario. High rates, low growth. If we are in for a stagflation kind of a scenario for next 12 months, 18 months, 24 months, then that will lead to serious equity or serious terminal value destruction in some of the companies. So should one be prepared for that? If 10, 15, 20% downside could happen?
Actually, Nikunj, I don't see that playing out, because I think that to manage this issue with the banks, the sense I have is that central banks will not raise rates adequately to kill inflation. So you will have the possibility of negative interest rates, and in that environment, real assets and equity as a sort of asset class won't do quite as badly. So I am not, do I rule out some kind of, serious volatility in the short term or sell-off in sector specifics? Not at all. I mean, that can easily happen. But if I were to take a 5-year plus view, I think equities is still a pretty decent place to be in. And I think that, if I look at all of the option set, real assets and equities is probably still the right place to be in, largely.
Okay.
The levered part of the economy, one has to be ultra careful about. Right?
Okay. let's wrap it up with the one comment, something which was our first question last time, but the mood of the market has changed, so it is the last question. When we interacted with you last time, we started by asking you a question on fintech and consumer tech. Today, that is the last question because the market mood has changed. What happens to some of these consumer tech and fintech companies? Because these are the companies where, cash crunch will be there. These are the companies where, growth will get compromised. The terminal values will change. Are we in for another bout of meaningful downside for consumer tech and fintech stocks?
Look, there are businesses in the fintech area which are solving real needs, capturing value, making a bottom line. I think that a lot of this acceptance of the fact that one could keep burning money because cost of money was zero, and whether you had cash flows 10 years later or 2 years later, it didn't really matter because your discount rate was close to zero. I think that has fundamentally changed, and I think that the old-fashioned wisdom that cut your cloth as cut your coat as per how much cloth you have. I think that's we need to go back to that, and I think we are seeing a significant portion of that. And I think that what will happen is that the good companies, there is no shortage of capital for even today. And if you look at the amount of capital out there in the venture industry, the PE industry, the undeployed capital, there will be no shortage. I think people have simply gotten a little bit more picky. That whole thing of trespassers will be funded, which is the kind of environment we have lived through for the last decade or so. That is, to my mind, done and dusted, at least in this bubble cycle.
Rahul Basin, really appreciate your time, and thank you for brilliantly outlining all the important developments, what it means for India, what it means for our viewers, and what should our viewers do in this kind of environment. Where we got a full house from Rahul Basin to market veterans Samir Arora, Shankar Sharma, Quant Mutual Fund, Vikas Khemani, Nilesh Shah, and good old Manish Danki. I mean, that's the advantage of watching it now. Complete full house 360-degree analysis from bond market to equity market to commodity market to what essentially are some of the big asset allocators doing. But I'm going to shift gears and talk about China, soda ash, chemical trends, and demand in Europe. Mr. R. Mukundan, Managing Director and CEO of Tata Chemicals, joins us now. Let's understand from him. Mr. Mukundan, always a pleasure to have you on ET Now. Thank you for joining us. First things first, how is the demand dynamics of the soda ash market moving in the light of what is happening to China and in the light of what is happening to Europe?
Good morning, Nico. It's always a pleasure to be back with you. And I just want to say that we are extremely watchful. So because of what you just heard in terms of the market issues, but really, even as we are watchful, we are just seeing that the demand is holding up. The real demand is holding up. As far as the markets are concerned, they are fairly balanced. And last year, for example, for the first time, China became a net importer. So the China reopening hasn't really fully played out, but I think it's beginning to play out. But we are then having to be watchful of the kind of rebalancing of supply chains, which is going to happen, which is going to benefit India. And we're also seeing another trend, which is that the US has emerged as a low-cost production center for many of the energy-intensive businesses like chemical sector. So again, so we find ourselves in a bit of a sweet spot being present in India, present in US. These are our two biggest manufacturing sites, and the market is on an uptrend as far as we are concerned. We're also helped by some level of, I would say, the changes which are happening in the external environment, mainly driven by, I would say, the sustainability trend. So one big part of the demand actually has been the chemicals needed to make the solar PV glass, which is of which soda ash is a big component, and also to produce lithium carbonate, you need soda ash. So I think those two sustainability trends have been growing at about 6-7%, even as the other sectors of the market have been growing between 2 and 3%. So that's broadly the global market demand trend. And what we were concerned last year through this calendar year, which finished, was the European situation, given the unfortunate conflict there. And I must say that we have been extremely positively surprised by the way our UK operations have held up. In fact, because of the very, let's say, good risk management from our side in terms of putting in hedges and making sure energy was hedged, I think their margins did expand and they become profitable for the first time after about 7-8 years. And the trend is likely to continue. Kenya also benefited because of this uptick in the market. So our Kenyan operations today are debt-free. And we have delivered to the extent of approximately $150 million in this rising interest environment, which effectively has meant that while our debt has come down, we have almost similar interest costs. So overall, the margins and profits have certainly increased.
Okay.
Sure, that's great. But tell me, Mr. Mukundan, is it reflecting in your volumes right now, the dynamics which are currently playing out, the China reopening and the global recession?
Yeah, I think we're fully booked out, so it is reflecting in the volumes. And I think next year, for example, what we are planning is additional 200,000 tons capacity coming on stream, which I think is fully booked out again. So every year we'll have additional capacities being brought on stream. We do have plans to expand at least by about 1 million ton over a period of time, and that program is on track and is going to get absorbed quickly in the market. To give a broad indicator, this is about a 50 to 60 million ton market and growing at about 3 to 4%. The world needs about 1.5 to 2 million tons of material every year additional. I think if growth tends to continue the way it is. We've even tracked what was the worst fall in 2008, sector by sector. What was it during COVID? And what we can really see is this market at best will be tight to balanced. I think that's our prognosis going forward.
If I look at the commentary which has come from your peers, and in this case, your nearest peer I can see is GHCL, they are making a case that the soda ash cycle is in a multi-year uptrend. It will not get affected because of what's happening to the global energy trends, and if at all the Indian demand is going to remain robust. Do you see that kind of an optimism? I was looking at your conference notes also for last 2 quarters. There is no iota of concern there. So can I say the soda ash cycle in India at least is at a multi-year trend?
It's not an Indian trend, Nikunj. I think this is a product which travels around the world. So really, I think if you see our capacity, we are today maybe second or third. I think depends on how you count our capacity in the world, and our largest capacity is in US. I think one of the key components is that US has turned to be the most competitive place to produce soda ash, and that is and in these sort of products, it's very important to be cost competitive. India also is very cost competitive, and China is not adding too much of capacity. About 4 to 5 million ton is going to come, but it's going to come in Inner Mongolia, and that's very, very way off from the coastline, and they're going to have a cost of transporting it and getting it to the port, and hence it's going to most probably serve the domestic market. So overall, I think the kind of softness we saw in the market because about 4 to 5 million tons of capacity came in Turkey, that has been fully absorbed in the market. There is not such a large capacity coming on stream in a very short span of time. So this is all going to be, 1 million ton added here, 500,000 ton added there. So and that kind of capacity increase is needed in the world, mainly because I think if you want the markets to move in a very balanced way, which is what all of us want as responsible supply chain partners to our customers, I think really we want this to grow in a very balanced way. So these capacities are needed, and they're coming in a much more calibrated manner as we go forward, because that kind of a big spike which happened, I think 4 or 5 years ago, that has been more or less absorbed.
But Mr. Mukundan, tell me what's happening with input prices and the realization trends when it comes to the India market?
So the pricing is more or less going to be flat. You would find sometimes it's going up by, $10 here or $10 down. I mean, I don't see that as a big reflective. The input costs are more or less stabilized. I can only say that. I think around the world, there is a stability in input costs. The supply chain bottlenecks have eased, so material can move freely. The port movements are much easier. The freight rates have come down. In fact, the fall in the net realization has actually been not much, but the gross realizations did fall because I think the freight rates did come down, the shipping rates did come down. So they've also stabilized now. So we are seeing softness in input costs, and demand continues to hold up. Last year, for example, just to give an anecdotal piece of the market, which we were very concerned about, the European business. Europe, in fact, shipped the highest amount of container glass ever in its history, in a year where we were actually fearing the worst. So that sort of tells you that sometimes we read the headlines, but you got to go behind the headline and meet your customer segments, and stay close to them. And I think what we can see from our customer segment and our customers is that the demand is still holding up, and they are also equally watchful, because this is a difficult period to navigate through. But we are very confident that the short term is holding up, and in the medium and long term, I think this business is in a sweet spot.
Thanks so much for joining in. And I wanted to understand if now plans are being revisited when it comes to some sort of an EV plant or looking at EV batteries. Is there something that's being looked at in this vein?
So we are going to be, as a group, the Tata Group is certainly looking at it. As far as Tata Chemicals is concerned, we are focused on being a supply chain partner to that entity. And already we are present in the value chain through being a vendor to lithium carbonate manufacturers in South America, who are one of our big customers. And we would continue to engage in looking at supplying whatever chemicals that entity needs. So I think that work is progressing in the lab, and we also eagerly await that these plants in India come up and we can be a supplier of choice to them.
The battery manufacturing business for Tata Chemicals. Are you at a breakthrough moment where what looks like an incubated idea could actually be a significant contributor in 5 years, 7 years?
Yeah, I think if you look at the areas which we are focused on, one is the silica business which we incubated. I think the tire industry is also going through a transformation in terms of going towards green labeling and green tires. And I think the dispersible silica, which is one of the products which we launched, is fully the pilot line of 5,000 ton is fully booked. In fact, we are short of capacity there. We are thinking of pivoting part of the food line which we had in silica food to the tire grade, and we have, as we mentioned, going through a process of investment to expand capacity 10 times to 50,000 ton in a phased manner. So we are looking at pockets of what I would call the chemicals which feed into the sustainability and green trends across various sectors, and we'd continue to sort of engage in that.
But Mr. Mukundan, I've had the pleasure of tracking Tata Chemicals for years, and I'm aware of the small businesses which you're trying to incubate, the kind of experiments which you're trying to do and where you're investing. Somehow Tata Chemical has not really managed to add large revenue lines despite their focus. So 5 years from now, will Tata Chemicals still be known as India's biggest manufacturer of soda ash, or it would be a very different company? Because a lot of Tata companies have gone through a new avatar.
Yeah, so I think, Nikunj, for us, the main business which we are in is actually a large chunk of our business. So I really think if you look at the revenue growth, I think we've moved from about 12,000 crores after divesting the food business into demerging it into Tata Consumer. Our revenues did fall, but I think we are back to where we were pre-demerger at about tracking close to, let's say, 17,000 crore. We should be crossing 20,000 crore next year. So I think we've been growing at a good clip, but a large chunk of it as a proportion continues to be our main business, which is sodium chemicals, which is soda ash, bicarbonate, salt, etc. So I think they are profitable businesses, giving a bit of 40% plus. So and if demand environment is good, it is only natural that you would continue to expand, because we don't want to lose our leadership position thereby. So we are focused on maintaining our leadership. At the same time, I think the new areas will get seeded, so that space would grow. But given the market dynamic today, it's a kind of good spot for us to also continue to invest in businesses which we know well. The issue is not about the product itself, it's about the applications of the product. I think one of the key things which has happened to this chemical is that I think it has found more sustainable applications which are more driven by sustainability trend. I think if you dig deeper into the sectors into which it sort of supplies, I think that has undergone a shift and change, and that's the positive side. So I don't know whether you look at it as a strength or weakness, but I think when your core product is growing well, I think it is better to also focus on that and not to lose leadership there. I think leadership is pretty critical, and having a multi-locational, multi-geography supply chain capability is very important. And I think we will continue to keep that as our strength. But at the same time, we would continue to invest. For example, we do believe silica is a new area for us across the silica chain, and the area of rubber and tire materials. And as something fresh keeps coming up, we will keep pushing our investment in that direction.
Appreciate your time. Thank you so much for giving us a clearer idea of Tata Chemicals' plans down the line and what the outlook is for the business. So as of now, they're saying that the demand drivers are lithium, ion and solar glass. China reopening has begun to play out and their capacity is fully booked out. Time to take a very short break. Be right back as we continue to focus on the markets and get you more perspective. Welcome back. Given that a lot has transpired overnight, our markets are down 0.6% for the frontline indices, but the real pressure is being witnessed within the broader market. So pull up the mid and the small cap indices, actually the small cap end of the market, because that's already seeing a gash of about 1.5%. And this is after that outperformance that we've witnessed for the last two trading sessions. So perhaps this is really a true reflection of the sentiment in the market. Names like KPIT Tech, Hindustan Copper, Wellspun India, Cyient, Tanla Solutions, NBCC, they're all under pressure in trade. But let's discuss then the impact of the fallout of the Credit Suisse turmoil, what the outlook is for global markets, as well as where India stands with Rajesh Kothari, CIO at Alpha Accurate Advisors. Thank you so much for taking time out. And I just want to get in a sense as to what your outlook is as to how one should really read into the situation amid this acute volatility. Clearly now, investors will be raising a lot of questions when it comes to the global financial system and in terms of a lot more regulatory pressure perhaps on these corporations down the line. Is that going to be on top of mind?
Well, I think I think you started with the absolutely very right question, and undoubtedly there is a global uncertainty, a little bit more volatility. But I think the biggest lesson, I think the regulators have also learned in last 20 years or so, particularly post-Lehman collapse, is to be agile and to act fast. So if you look at SB financial crisis, before market opened up in Asia, US Fed came out and they supported not only the depositor, but they gave a solution to the full economy that set an example, correct? And same thing yesterday happened even for, Credit Suisse Bank, whereby, the new lenders came in support of Credit Suisse. So I think the world has become, agile because there are two important factors: social media and, of course, the sentiments, and both need to be addressed in a right way. Otherwise, it can create chaos. And that's good news, from the equity investors' perspective, because it basically helps to contain the crisis to the specific case rather than allowing it, and to make it a contagion effect. And I think that's basically a good thing. And that's why if you look at the global market, despite these two crises, the US markets are not going down. I think, therefore, one needs to give a little bit more time kind of thing, needs to have a little bit longer time horizon. And in fact, if you ask my personal view, we have opened up mid and small cap PMS, which was closed for inflows because market is corrected handsomely. The valuations have also now corrected. We are getting mid cap index and small cap index at almost probably less than last 10 years average valuations. And in India on ground, the economic growth is remain rock solid. The story is still good. Look at GST collection, look at fuel consumption, look at any macro parameter. I think as in India, we are doing reasonably well. And I think it's provide good opportunity. That's why, in fact, we opened up our AAA budding list mid and small cap offering again for open for inflows, because I think it is a good entry point for investors at current level.
Okay. What do you think is now going to be the approach, or what should be the approach for a lot of investors at the current juncture as we're making sense of all that's taking place globally? Do you think that there is now going to be a tilt towards perhaps safer havens for investment?
Undoubtedly, I think when you say safer havens, it all boils down to what kind of quality you are buying. You need to make sure that the companies what you have bought, they are resilient. They are fundamentally, of course, very strong. They have the best of the risk management practices. And of course, as a investment house, what we believe in diversification to make sure that if there is any shock, you should be able to absorb that shock. So the companies need to be agile enough. Their risk management practices needs to be, of course, strong because the world is changing very fast. And you need to make sure that you don't get hit unnecessarily from macro or micro factors. And therefore, definitely there will be premium for the quality because world has learned that, there is nothing that you can predict. So even the top 4 auditor firms who have audited CS or SVB, and in matter of days, you know what has happened. So it is extremely difficult to predict such events. Make sure that you don't get hit unnecessarily from such global events.
You do right now, Rajesh? Book out from all the profits that you're sitting on, or buy the dip already?
I think as a house we are very agile. If required, book the profit, and if required, buy at dips. So that strategy varies from company to company, stock to stock. Our view on the company and their earnings growth over the next 12, 24, 36 months. And that's what mantra, what we always believe in. Remain agile, remain nimble. If required, exit the stocks where you think that probably things may not work as per what would have thought 1 year back. So discipline exit strategy is critical.
I'm sure it is. So give us a glimpse into the agility. What is it that you've been selling? What is it that you've bought already?
Difficult to talk stock specific, but on a macro level, I can tell you we have been bullish on capital goods as a theme, and that is working very well. Banking is another theme on which we are positive. Of course, you need to be very, very selective when you buy the banking stocks. Pharma, we have been avoiding almost from last 2.5 years, post October 2020 on lockdown of COVID. We are avoiding pharma. IT is the one sector which we have been underweight since last about 12 months, and our view remains the same. So broadly, these are the basically, our sectoral call from the portfolio perspective.
Just appreciate your time. So glad you could join us. Now, what do we have in the market? Bank Nifty down, Z is up. IT stocks are selectively down. Nothing actually is down in a meaningful manner, but just that, drips and drabs of negative price action. You've got consumer stocks. Thought as much, something what we were discussing yesterday. Consumer stocks are making a comeback. Why are consumer stocks making a comeback? Very simple. These are domestic focused companies. What is happening in the world will not have an impact on Nestle Maggi sales. It will not have an impact on Dabur Chyawanprash. It will not have an impact on Britannia biscuit sales. Commodity prices have started coming down, and if commodity prices are coming down, the margin pressure which some of these companies had to absorb, some passed on, some did not pass on, suddenly translates into a clear margin visibility. So defensives, local, commodity prices. These are three words. If you put them together, they resonate very well with market in this kind of a tumultuous time. And that is the reason why markets, in a sense, are making a comeback. All right, now let's stay with what's happening to US banking sector, European banking sector. Arun Jain, Chairman and Managing Director of Intellect Design, joins us now. Mr. Jain, good morning. Thank you for joining us. The view in the market is that a business like Intellect is heavily dependent on US BFSI business. And if anything goes wrong there, the after effect of that would be immediate. First, what is your correlation with SVP? And in last 1 week or 10 days, have you got anything which gives you a sweat on your brow, anything which is disturbing, anything which is negative?
Okay, so just to tell the investors, Intellect has only 7% of the revenue coming from US market as of now. So that dependency on US market is much, much lower than anybody else. Out of which 7%, 80% of that comes from AI and cloud business, which is on an upswing investment rather than a downswing investment from the perspective where we are looking to grow the business in US, because these are the investment buckets which are already well committed, and it is must investment. There's no choice a customer has in these investments.
What about Europe? Because when we contacted you, sir, the problem was America. In last 24 hours, the problem has moved from America to Europe.
I think we need to understand the problem at a more systemic level, system level, operation level, and business level of the banking industry. In absence of detailed analysis, the investor community a lot of time reacts based on visible symptoms like Brexit, Trump, Russia, Europe, SVB. These are only symptoms. Since I'm designer of banking technology over 37 years, I have observed there are four-dimensional complexity of global financial banking system, which can be presented through the regulation frameworks, which is represented through the interconnected world, which is connected to the economic fluctuation which happens. And after all, the 5 generation of technologies, they are sitting with the residual legacy in each of the spaces, which exposes the risk in each of them. So this is the complexity pyramid which bank has to solve, and this has to be, they have to untangle it, which can only be possible with the technology. Technology is a key piece to remove the residual risk. And in that area, we have designed the new set of technology, which is a Wave 5 technology, which is phenomenally different from the earlier technology, where holistic design plays a critical role in designing the banking ecosystem. So there are banks in US like Capital One, which has grown in last 10 years so beautifully. JPMC has grown so beautifully. Wherever the technologies are deployed in a right earnest, whether in Europe or in America, they've done a great job.
But Arun, what can you tell us about client confidence at this juncture? Have there been any panic calls to try and reduce contracts, pull out of deals, or that panic hasn't set in yet?
There will not be any panic. The only point I am saying, this is happening every time whenever something happens like this of one bank. These are foolish decision of a banking risk committee. They didn't have even asset liability management system, which is so surprising to me sitting in India, that asset liability systems we have built 25 years back for Citibank, where they were, how can one bank can have a dependency on one asset portfolio? And that should not be contagion on other banks. And unfortunately, industry is reacting on the symptoms rather than systemic issues.
How is this current problem in US financial system different from 2008 or 2012 or 13?
They're not different. They're localized problems which have a contagion. But if I look at it, the role of a technology in all the 4 waves, the technology spend has gone up and that has given the sense of urgency after this event for investing more. Our technology of eMAG.ai, which we launched last month with AWS, it's about converging 5 things together. The events will happen, the microservices, the APIs to connect the interconnected world, cloud and AI in a embedded manner. So you can create a composable solution and you can design the AI. So our proposal to the bank is they need to design business operation technology in a holistic manner, and they can co-design with their vendors, with their in-house teams. It cannot be outsourced agenda. There's a definite shift on wave 5 of the technology. So wave 1 from mainframe to mini to micro, this is a wave 5 which is happening in the world. Bank has to invest more in technology than reducing the technology cost.
So if I have to, let's say, get your outlook for your shareholders and for those who track the banking stroke, the entire IT space or the BFSI space, you are of the view that the nervousness in the market, which is about a regional banking problem in US and a big single bank problem in Europe, if markets fear that this is going to be having a systemic impact on the IT outsourcing and the BFSI space, that is far-fetched. The reality is not like that. The reality, it is business as usual.
As usual, I think it will force banks to move to the cloud technology faster, move to AI technology faster. They need a holistic transformational budgets like CBA in Australia, the banks in Canada having a much bigger market cap for the banks who have still living with the old legacy technology of last 4 generations. So people who have invested in time, they have reaping the benefit of today outcome. It's not about regional bank. It's not about European bank. It's about whosoever invests at the right time, but right time in the right way, not just putting a dollars on managing legacy technologies versus spending money for transformation and designing the new technology.
Say that what you are indicating about intellect design, that may hold true for the entire IT outsourcing sector per se. Can we paint everything with the same brush that what you are experiencing in terms of an outlook and commentary from your clients, that holds true for the entire sector per se?
I would not say for entire sector. Some of the sectors, if they are not in a latest technology of wave 5, which is a cloud, AI, microservices and APIs, if they are in a backward routine job of BPO, I think those are the places where we need to have worrisome pointers. But anybody who has moved from wave 3 to wave 5 technology, I think they don't have a worry. They have a positive signal because now we can push to the bank to invest faster than we were telling earlier. And they were saying, no, it's okay. Life goes on. But this is a moment of urgency for them.
Okay, Arun, great to have you on the show and, bring in that amount of clarity as to what really is going on with, your business specifically in the Europe as well as the US geography. Very little exposure and no panic yet. That's the messaging coming in. Metals, by the way, still taking a knock. You're not seeing any respite there. Tata Steel, Hindalco, SAIL, Jindal Steel, all down. Motherson, of course, is down 12% after that block deal. Nestle, Titan, Oro Pharma, and then the oil sensitives, BP, HP, IOC, they're the ones which are holding out in trade. But besides that, 16,953 is the print on the index. It is a sharp blow, technically, yes. And more importantly, the Nifty Bank already cracks up that 39,000 level. I don't know what it's currently at. Let's just bring up that up for you, yeah. We're significantly sub the 39,000 mark on the Nifty Bank. 426 points lower as we speak right now. We'll take a very quick break, but lots more market voices on the other side.